Hey guys, this is Julie. Want to show you that I think the PT indicator is better than the VIX. I can get a benchmark for volatility on a standard basis that is repeatable, benchmarkable, and also get the slope, whether the volatility is rising or falling, and see how market is reacting to that slope and direction, as well as the threshold level. And here I have demonstrating a volatility greater than 400. And as you can see, these represent the time to get the signal to go long. You've exceeded the normal range by far. Um, Here we saw it in March of the COVID. But before that, you can see that the Fed has compressed the NQ, always keeping volatility greatly, greatly reduced. I mean, for instance, right here it was under 90, right? Even these big swings was under a 90 volatility. This was in 14. So in August of 14, you can see volatility extremely low. Um, and they were keeping it under 100. Then we got some volatility spikes above 100, and you can see how big the market reacted. And then the market would calm down and turn into a tradable situation again, right? Where you could, count on some structure to the market so that you could get behind a position. And that is how they traded. Now here you can see an extreme volatility spike to 200. You see how controlled this market is, right? 100, 200. See, I do think my indicator is better than the VIX because I have this where we can understand it based on a scale of 100. And now you can see the COVID came out and we went 4, 5, 6 sigma. Look at that. 600, 650, 6 sigma event over the vol. Huge, right? Well, I don't understand. Well, see, here we got it above 400. 400 was the uncle point, right? Showing you that you had extended your threshold greatly, and the vol snapped back. Did it twice, right? 1, 2. Well, get over here, and we've just gone crazy. Many times over 400. February, March, April, May, early June, really May. And then sell in May, go away came out, and everybody started, closing their accounts or moving money to different accounts. And we got the slow, low vol sell off. Drove me nuts, right? You're not supposed to sell off on short vol. And so, a couple of things to think about that. Um, First, you need to know where you are in these distributions to know where the turning points, the line in the sands are for your risk, and to see if they're going to allow those lows to get taken out. And I think those lows are toast because number one, it is low vol. So any high vol we get next week on those CPI PPIs easily are going to take snacks to that low vol, right? Short, and it's going to take that out. Conversely, a beat, so like we get a really low CPI PPI, the market probably is going to skyrocket because we are so oversold all of those 400s, right? Well, that's the high vol, right? The high volume. They're going to come back and want to play in that. So, either way, we're going to have a good summer, is what I'm thinking. And so I'm going to show you the other half of the PT indicator and start layering on our higher time frames. So here is a monthly, and you can see that we got the PT3, 1, 2, 3. Here's your one, oops, 1, 2, 3. And again, the structure of the market has been holding. They broke it in February, came down to the tail precisely on my tails. And I thought yesterday we were going to hold up on that 71 because I was theorizing that if we're in a bear market, that the dealers are going to hit that short, right? Just like they did here. So I was looking for them to pound that short. They did not on low vol, and we broke it going up. And now the trick is next week, what to expect. And at a minimum, I can expect that the 1097.50 is going to be defended. So they could take those stops and stop on a dime at 10,987.52, right? Because that's your monthly one. But I'm going to layer on the other PT indicators because we can. So I want to put the monthly open, which doesn't look any different. Oops. I'm going to skip that one. It didn't really make any difference. This is the weekly, so I'll add weekly and 45-day, and these two are the 45 days. And this will help open your eyes dramatically to why the market moves the way it moves. So now you can see that we have an upside level that acted as resistance, a weekly, right on the tick, and they did break that monthly one though. So to me, they're leaning higher, and the upside would be that 12/7/22/57. So that's your 45-day ones, and the theory is for the 45-day contract, you want to keep it inside the ones 68% of the time. So they'll be having their call walls sitting up there and selling their puts down here. They don't care as much if the calls get broken, but they do the puts because that's really, really high and limited risk, potentially, like we saw in March of 2020. So with short vol, that is going to be snacks to any high vol shorts because that'll get easily taken out. But we've got a line in the sand holding price at, again, write that down, 10,987.50. If that 10,987.50 breaks, then you've got your hedge funds hedging that risk because that broke their puts. So you got to know where they put their puts and calls, and hopefully that can help you navigate the market. And as you can see, I am not blowing smoke up your ass. You can see that they keep the price inside as much as possible, and when it does break, like it did in this last, you know, down cycle, they control it by going to the threes. They don't let the threes break. The guys, the tasty traders, they never lost money this year. All of their spreads, if they hold them on the threes, they all held up. Look at this, every single one of them. I mean, it is freaking amazing to me. Um, so the threes on a catastrophic event would be down at 10, 0, 15, 15. So we know that it will likely be the low, low, low. But I would imagine this first one around 11,000, right? 10, 985, 987, 50. So there is my prognostication. Weekly resistance, we're sitting on it. So I would imagine we would explore inside the whites. If we do go up, if it does pop up, you've got another resistance at 12,434.50, and then another one at 12,613 before you get to their call wall. All right. So a little bit bumpy overhead. Nice open unobstructed view inside the one. So that's probably what we'll see price trading at. Thinking about the CPI, PPI, I don't know. I don't know what to expect. Just trade it how it comes. All you have to know is whether the vol is going long or short, and that should help us understand the behavior of the market. We're seeing shorts on short vol, and it is crazy. It is driving me insane. I have been complaining about this all year. So I guess that is a function of the bear market. Or like I was saying earlier, selling may go away, and people have just been programmed to close their accounts, and the institutions are not joining them. That's why you're not seeing the volatility on those shorts. All right, guys, that's it for me. I sound like I repeat myself a million times, but you've got to, see the higher time frames like I can and the volatility levels. I am telling you, these higher time frame guys that they know what they're doing, it's not me making this up. I just got lucky and created an indicator that captures higher time frame values pretty well, I think. All right, kiddos. Talk to you later.